Welcome back to the Williams Real Estate channel. Vlog number 4, I think it is now. On the boat again, taking it just for a quick spin this Saturday. There's lots of sailing boats out today, so I'll be ducking and weaving a bit. And I thought the topic for this video today, I've been getting a lot of people asking me what will happen during the next land driven downturn come 2027 and onwards. It will be like the next GFC event, like what happened in 2008 or the one prior to 2008, the 1991 land driven downturn, also known as the recession we had to have, or 1972 early land driven downturn, wasn't called specifically anything, and 1955, 1933 Great Depression. So these days governments are a little bit more, definitely more responsive to combat the downturns by dropping interest rates and printing a lot of money, so the downturns aren't as significant or last as long as what we, or the global markets, experienced in 1933. But being more specific, if we look at history and we study history, we understand what happens in these large land driven downturns, we can understand what could happen in the next one, which is due come 27, 28. So from top down, from absolute horror story to the stuff that we're buying, because there's always a market and a type of product that will actually perform during that period based off history. If you study your history and study the sales data, which is what we do. So to paint a picture of where we are today and leading for the years ahead, I believe we are sitting right now, based off various metrics I use, based off the 18-year land cycle, we are sitting equivalent point of time mid to late 2005 as of February 2025 today. That's, if we look back at history between June to December 2005, that's the equivalent point in time we sit, or 1987, 1988 equivalent point in time. So we're about 16 months or 18 months to 2 years away from peak market. So between now and then, where the market will top out in 2026, inflation is going to maintain sticky, so it's going to be hard for the Reserve Bank to drop interest rates. I know everyone wants interest rates to be dropped low again, cheap money, that's always nice. I mean, I would love rates to be dropped now and on the 18th of Feb, but the reality is, with the trim mean inflation sitting at 3.2%, and the RBA's target is to have it maintained consistently at 2.5%, there's still a long way to go and a lot of work. So I don't believe rates are going to come down. I believe they'll stay on hold, and if they do drop it down, then that'll then set off another wave of inflation, and then they'll be chasing their tail again, raising rates even higher. So in one mind, I would rather than hold, because if they do drop, then I mean it could get very nasty very quickly. Because if you look at the states, they've got a target of 2%, and they got to around 2.4% in September in 2024. But since September 2024, it has been trending up again. So we could be on another wave of higher inflation. So I believe rates are here to stay. Jerome Powell says he's not dropping rates any lower than 4.5% in the US, and we're already sitting at 4.35. So there's no reason for the Australia to drop rates lower when we're already lower than the US. So that's firstly, so having that knowledge and then understand the commentary of what Michelle Bullock is saying. She doesn't believe inflation will be maintained within the band until mid-late 2026. So at that point, it'll be, you know, hitting well top of the market, and then once the market then turns into 2027, they'll then panic and drop rates quite quickly, very low again, and print money, and just like what they did in 2020. So that's the cash rate, that's inflation outlook. If they do drop it in the near term, they'll be raising it up higher. So I don't believe so. And if you look at what they did in with the cash rate between 2001, 2 all the way up to 2007, it consistently went up. So I believe it's more or less going to consistently look like that same pattern. History doesn't repeat, but it rhymes. So time will tell, but my gut feeling is rates are on hold. They are conservative, and they won't be dropping it until it's well evident that we're entering a downturn. And once we enter the downturn, people will panic and be selling assets, and if you look at history, stock markets can take easy 50, if not a 60% decline from their peak. So over the 2025 and early 26, I'm going to continue to move my liquid assets, so stocks, super that's invested in the ASX 200 currently, because in the second half of the land cycle, Australian stock markets typically outperform, because we've got predominantly banks, mining and property, which is what performs, and commodities, which is what performs in the second half of the 18-year land cycle. So that's why the Australian stock market tends to perform in the later stages of the cycle compared to other asset classes. But I'm slowly moving that over, because once the market turns in 2027, the stock market will get halved easily. Cryptocurrency, I mean, I've dabbled a bit in it, made a quick buck here and there, but I'm not a big fan of it. I believe it will potentially get wiped completely out. In the 90s, we had tech stocks, big boom, everyone was charging in to, you know, start-up companies, tech stocks, all the bullshit. Everyone made a quick buck on the way up, but then when the market turns, everyone lost money, or 99% of people. So when you hear from one of the most famous investors in the world, Warren Buffett, not even supporting cryptocurrency, call him old-fashioned, but the reality is, when you buy cryptocurrency, no one really understands or can explain what you are buying. The blockchain, the woozy-wazzy. It's not like real estate where you've actually got a hard asset, you've got bricks and mortar, you've got a title of land and a site. And it's not like buying shares in a company where you own the shares in a business. Who knows what it is? The blockchain could be the future, but that's what they were all saying about the tech stocks back in the late 80s, when the internet was first invented and everyone was jumping on that bandwagon. So I would definitely not be surprised if crypto gets completely wiped out. Bitcoin, they say, you know, some of the crypto kings are saying, you know, Bitcoin's here to stay, it's the original OG, all that sort of bullshit, but I also hear that Bitcoin's not that efficient anyway. So when something is not as efficient, it'll get taken over. So if the whole market is selling and there's not enough buyers, it will go to zero. Because what will happen is, when land price starts to go down and people who bought peak market, especially new and off the plan stuff, who are then in negative equity, the banks will be calling on their loans or saying at least to pay down your debt because you're in negative equity, like what they did in 2008, 2009. And they'll be selling all their liquid to pay down debt. Otherwise, the banks will be calling on the loans and selling the property. So cryptocurrency will be the first thing to go on, along with stocks, shares, everyone sells. So that will get hammered down to about 50%. Some businesses will go broke. So that will make commercial assets. If you lose your tenant, then you have no income, no earnings. And those that buy commercial property would understand that a commercial property is valued based off its income, based off its earnings. So if the earnings goes to zero, then the commercial asset is pretty much worth land value. So history has shown us that certain types of commercial properties that aren't as stable, that don't have rock solid tenants, can lose up to 50 to 70% in value in the land driven downturns. That's what happened in 2008, 9, and in the 91, 92 downturn as well. So commercial property will get hammered. Next, the high end, so all the fancy homes, big shiny stuff, all the mansions, that stuff can typically take a 20 to 30% correction. People can't necessarily afford the loans, get access to credit, because banks go very restrictive, trying to shore up their balance sheet. So trying to get a big loan will be hard. So that's when that top end can come off. New and off the plan stuff, that gets hammered, 20, 30% easily. That midpoint, so the mid-range, $1 million, $1.5 million, that's usually pretty stable. Reasonably affordable. But what I love and what we specialize in is the bottom end. So the entry level stuff, units in the metros for 200,000 to 350,000 will actually be performing and going the other way, because there'll be a shift to affordable. People will no longer be able to hold on to a big fat loan if they've lost their job, because the unemployment rate will get up to 10, 11% based off what we saw in 2008 and 91. It'll get back up there. It's already starting to trend up, so the trend is starting. It'll let, in 2027 it'll run. People will be getting laid off because businesses will be letting people go to cut on costs to shore up their balance sheets. So if people have a big fat loan, they can't afford it, or if they're renting a big house, they can't afford it, people will be bunkering down into affordable accommodation. There's always a demand for affordable accommodation. There's always a need for having a roof over your head. For obvious reasons, we are the lucky country. We've got mass demand, and the construction and property industry can never keep up with the demand. There's always demand and growing demand, and there's never enough stock. So the supply and demand equation for that entry level stock is never going away anywhere. Governments will probably be providing packages to kickstart the construction industry. That all feeds into the bottom end, and the bottom end rises. So when the top end's coming down, the bottom end actually goes up. So that's why we like to buy blue collar working class areas in great locations that are gentrifying, between that 200 to 350 range if it's a unit of a house. And then when we go to blocks of units, you get them even cheaper because you're buying a bulk deals. So I mean, I recently bought a block of 4 one-bedroom units for 665 grand. So it's 166,000 a door, a unit. So that type of stock will be in demand because there's always a demand for affordable end accommodation. Rents will be rising, the higher rents will be capitalised in higher price, and the bottom end rises. So in certain markets, in certain products, because Brisbane, Perth, Adelaide and the regions will be all topped out and starting a slowdown for a good between 7-8 years for for Queensland, South Australia, 15 odd years for WA. But the towns that are more dependent on the mining industry can go stagnant and flat and negative for a lot longer. If you look at the 20 years of sales data of Townsville, of any house, you'll see that in 2005, 6, 7, big run like what we're seeing now, sucks all the punters in, as it always does. All the stupid money likes to rush into overheated markets when everyone gets the fear of missing out. But come 2007, the market went backwards for 15 years to pretty much the same price point where it was in 2005. So that's what will probably happen again, you know, give or take a year or two, but that same pattern, that same rhythm will happen again to the overheated markets in the regions that are dependent on the mining industry. So be very cautious who you listen to, because I even see buyers agents out there pushing this type of stock who obviously aren't across the 18-year land cycle in history, and they don't understand what's coming, because when the market turns, people will be rushing back to Sydney and Melbourne. They're the most diversified economies, they have the most jobs, they have had 60% of the net migration intake over the last 3 or 4 years. They have been stagnant for the last 7 to 8 years, even more. We're buying deals cheaper than what people paid in 2015, 2016. So I love that. You always know it's a good deal when you're buying for half the rebuild cost. You got a 6 to 7% yield, and you're buying it for the same price, if not cheaper, than what someone paid for it 10 years earlier. That's it. Especially when you can get it off market, off a sales agent who's trying to push the stock because the seller doesn't want to pay 5 or 6 grand for marketing fees. So the sales agents don't care about a bird in the hand's worth more than 2 in the bush for a sales agent. That's why I get the good deals. It takes a long time to build the relationships. You need to do a lot of transactions, but when you can do quick transactions and you close and you don't muck around, and you don't pull out of deals, you'll get more deals. So every time I get good deals, even more deals keep coming to me. So if you want good deals, I've got at least a dozen good deals off market now that you can't find on realestate.com and Domain, that are between 30 to 80,000 up to 100,000 less than the CoreLogic valuations, and well over 150,000 less than the median price point of the suburb. So there's always a market, there's always a type of stock to buy, but it's understanding the 18-year land cycle and where we're heading and history, so you can be in the right market, in the right product, at the right time to enjoy the next bull runs, as they are only around the corner for Sydney and Melbourne. Until next time, thanks for watching. I'll put my details in the comments below. I know I'm not the flashiest videographer. I'm a construction property guy, so if you are a videographer, don't bother emailing me. I'll reach out to someone when it's time. I get bombarded by these people these days. But if you want help buying an investment property and building a solid, sustainable portfolio in the turbulent times ahead, reach out today. Happy to help, happy to have a chat, happy to run property reports of anything you got already. Until next time, good luck. I'm just about to take out a bloody sailor. Catch up.